So if you're a US person and you have a financial account anywhere outside the United States, there are two acronyms you absolutely have to know: FBAR and FATCA. Now, I know it sounds complicated, but these reporting rules are a huge deal, and a simple mistake can be incredibly costly. We're going to break down exactly what they are and, more importantly, how you can stay compliant. Okay, this is probably the single most important thing to get your head around. This is not about what you owe in taxes. Seriously, you could have a tax bill of $0, but if you fail to file the right information forms about your foreign assets, the penalties can be absolutely staggering. It is purely a reporting requirement.
So what does staggering actually mean? Well, it starts with this number, $10,000. That's a standard penalty for a single non-willful FBAR violation. Just think about that for a second. An honest mistake, one form you didn't know you had to file, could cost you 10 grand. And believe me, that's just the starting point. And this leads us to what a lot of people call the expat reporting trap. It's this super complex web of rules that can so easily catch US citizens and green card holders who are just, living their lives abroad, completely unaware they're out of compliance. And this isn't an issue just for the super wealthy. This can affect anyone with a foreign bank or investment account.
So why does the US government care so much about your checking account in another country? Well, the core idea behind all these laws is financial transparency. The main goal is to fight things like money laundering and terrorism financing by creating a clear picture of where US persons are holding their money around the globe. Now, this is absolutely critical to understand. We're talking about two totally different government agencies. FBAR reports don't even go to the IRS. They go to a group called FinCEN, which is the Treasury's Financial Crimes Unit. FATCA reports, on the other hand, are filed directly with the IRS, right along with your tax return. They serve completely different purposes. All right, so now that we know they're separate, let's really dig into the nitty-gritty differences. This is where you'll figure out if you need to file one, maybe both, or hopefully neither. Let's break this down. FBAR is filed totally separately from your taxes on a specific form, FinCEN Form 114. FATCA, though, uses Form 8938, and it just gets attached directly to your tax return. But maybe the most crucial difference is the scope. See, FBAR is laser-focused on financial accounts. FATCA is way broader. It includes those accounts plus other assets like foreign stocks or interests in a partnership. So the next logical question is, okay, but do I have to file? Well, that all depends on whether the value of your assets crosses a specific reporting threshold. And you probably guessed it, the thresholds for FBAR and FATCA are completely different. For FBAR, we're back to that $10,000 number, but the details are what really trip people up. You have to file if the combined value of all your foreign accounts goes over $10,000 at any point during the year. So let's say you had $6,000 in a London account and $5,000 in a Tokyo account for just a single day. Boom, you've crossed the threshold and now you have to report everything. Now, if FBAR's threshold seemed a little tricky, FATCA's is even more complex. The good news is the dollar amounts are much, much higher, but they change depending on where you live and what your filing status is. I mean, for an expat couple filing jointly, the threshold can be as high as $400,000. This is exactly why it's so common for people to need to file an FBAR, but not a FATCA form. All right, we've covered the what, the why, and the when. Now let's turn to the consequences of getting this wrong, because honestly, the penalties can be truly severe. Let's start with non-willful violations. An honest mistake. For FBAR, it's up to $10,000 per violation, which can mean per account per year. For FATCA, it starts at a $10,000 penalty just for failing to file. And if the IRS notifies you and you still don't file, that penalty can climb by another $50,000. These are not small numbers for an unintentional error. But if the failure to file is found to be willful, meaning the IRS decides you knew you had to file and you just chose not to, well, the penalties enter a whole different universe.
For FBAR, the penalty can be the greater of $100,000 or a jaw-dropping 50% of the balance in the account for each year. Yes, you heard that right. Willful failure could literally cost you half of your assets, not to mention potential criminal charges.
Okay, I know hearing about those penalties can be pretty nerve-wracking, especially if you think you might have missed a filing. But there is some good news. The IRS has actually created a specific path for people to get caught up without facing those really severe consequences.
This path is called the Streamlined Filing Compliance Procedures. You could think of it as an official off-ramp to get back into compliance. The most important word here is non-willful. This program is designed specifically for people who made an honest mistake, maybe didn't know the rules, or got some bad advice along the way.
So how does it work? Well, the whole process really boils down to 3 key actions. First, you file the last 3 years of overdue or amended tax returns, and you include any necessary FATCA forms. Second, you go back even further for FBARs, and you file the last 6 years of those. And third, you submit this critical document where you certify, under penalty of perjury, that your past failures were not on purpose.
And this isn't some obscure, rarely used process. It's actually a pretty well-trodden path. Thousands of Americans living abroad have used this exact program to get right with the IRS and the Treasury Department, which lets them avoid those worst-case penalty scenarios and just get some peace of mind.
So, let's wrap this up. U.S. foreign asset reporting is, without a doubt, complex, and the stakes for getting it wrong are incredibly high. But the most important thing to take away from all this is that if you've fallen behind, there is a clear official path to get compliant. It all starts with understanding your specific obligations, which leaves just one final question for you to consider. Are your foreign assets compliant?